Just want to try and go back to product market fit being so transient, because if product market fit is transient and revenues are highly unreliable or unsustainable, as we're seeing with your Gen AI companies that scale to 20, 30, 40, 50 million very quickly, but with a lot of potential sugar high. If we've got revenue unpredictability, PMF unpredictability, what are we underwriting?
Yeah, I want to know what Rory says, because I don't know right now.
If you're not understanding that you're underwriting more risk, you're missing the movie. You're taking on more risk. What you're underwriting is the upside, right? You know less at every stage on every check you're writing today. You know less than you would have known 10 years ago at a similar stage SaaS company. A lot less. A lot more things can go wrong. But on the other hand, the upside is there and it's huge. You're just taking on more risk per dollar of revenue.
Is the upside there and it's huge? Because the prices are inflated much higher than they were 10 years ago. It doesn't feel like you're getting paid for the risk that you're taking.
Well, disaggregating that, because again, you inject a price into the equation at the risk of channeling Monty Python. As a reference to the Holy Grail, but leaving aside price. In other words, do I think the outcomes of these companies can be huge and arguably even bigger than some of the SaaS companies? Yes. So, quote, the upside is there. Now, the worst of all worlds, as you say, is if you've got high product market fit variability, high risk, still good big upside, but then you pay up so much that even that upside has been competed away, then it's a sucker bet. And yes, that would be bad, right? And some of these questions. And look, it's a very scary time to play the game today, right? I mean, we all do it because we enjoy it, but every time you're writing a check today, you're going, I know a lot less than I did on some of these other things. I'm paying a bit more. The upside is amazing. Oh my God, look at that growth. But we've seen companies fall off the growth track, in 6 months. So it's pretty scary. Turns out making a lot of money is hard.
Rory, do you think we're going to have in venture, do you think we'll have more bimodal results where a lot of funds will just be massive unperformers because it's hard to assess the risk properly?
Yes, by definition. I think, and for two reasons, and we'll talk about it. One is each individual deal has more risk in it. And then on top of that, it's a totally separate thing, the holding periods have elongated, right? And every year holding period elongates, one of two things happen. If you roll the dice, and if you win, you go up 30%, and if you lose, you go down 50%. If you roll the dice 3 more times, by definition, one company will go up 2x, and the others will go down. So yes, it's going to be, portfolio construction really matters here because you're in a riskier game for a longer period of time. And yeah, some of you are going to make it, but a lot of you are going to not. It's scary.
I had Victor from Benchmark on the show, and he said that portfolio construction doesn't matter. His first check was 8% of the fund with $55 million into HeyGen, which was, I thought, a lot. Jason, we've spoken before about percent of check as a percent of fund. 2, 3 standard, 8 is a lot. And he said that bluntly, they can raise whenever they want to at will. So $500 million fund, it can be deployed in a year. We saw KP deploy a fund in 12 months. I guess my question to you is, if you're a brand name firm that can raise on demand, does it matter?
I think it always matters somewhat. People actually lose money as distinct from thinking about losing money, or in particular when they lose money 2 funds in a row. Even a brand name firm can hit a bump, right? I think someone as amazing as KP and Benchmark. No, I never take it for granted that you can win that you can raise money. Because I'm sure Jason's had the same experience too. My partner Kate and I raised our first independent fund in 2009. And, we were in the Lehman and AIG offices the day it went bankrupt. And it turns out they didn't need to add to their exposure of private illiquid assets that week. And, I never take it for granted. It was damn hard. It took a year to raise that money. So probably true for Benchmark and KP, probably not true for the other 898 funds out there.
We were talking just about kind of like, hey, we see the growth and the question is, are we getting paid for it? What about the normal SaaS companies? There are thousands and thousands of SaaS companies that will listen to this and be going from 1 to 3 million in ARR, maybe 1 to 4.